More and bigger cracks are appearing in the labor market. Not only that, we have data which shows the employment situation last year was substantially weaker than first thought. And now we're seeing signs of deterioration heading into mid-year. One of those signs is the nascent Treasury rally that has pushed the 10-year Treasury yield back into the 420s all over again. The possibility of more serious labor market weakness is pushing interest rates down toward lows from earlier in the year, and everything hinges now on jobs. We're halfway into a recession, so the question is, how far from the other half? What we're getting from the data is the sticky inflation freakout during the winter, and the resilient economy narrative that always comes with it was just another temporary head fake. A little bit of a bounce toward the start of the year that is fading from all angles. This current cycle has been unusually prolonged, and because it is taking forever, it lends itself to short-run cycles within cycles such as the one we just went through. Now, we'll go over what signs people should be looking for on both the longer-term and short-run time frames, and I'll give you another one in construction, a potentially critical cyclical warning from there. The truth is, income's never caught up from the supply shock, and the weaker the labor market gets today, the more people realize they aren't going to. That has profound consequences in the short run, the long run, and everything else in between. So we'll start with the Treasury market. The Treasury market, the 10 years down under 429. That's despite the fact that the ISM non-manufacturing index came in much better than it was expected. But despite the ISM, we got figures from ADP and a whole bunch of others suggesting labor market, labor market, labor market. Incomes. Everything depends upon those. So the 10-year Treasury down to 429 today, the 2 years at 474 as the market begins to reprice what Jay Powell is going to think about all this. Because as I mentioned in a recent video, the market is trying to sort out how policymakers are going to react to both consumer price numbers as well as weakness in the real economy. Because they always have to balance those two risks. Over this winter head fake period, they have shifted back toward worrying about CPIs as the CPIs continue to come in a little bit stronger than had expected. They actually got to, not really stronger, but they got to be more sticky than anticipated. But as the consumer price problem predictably fades, especially as energy prices continue to go lower because of weak demand, policymakers are going to turn their attention more and more in the opposite direction, as central banks around the world already have. We saw the Bank of Canada cut its rates today. And tomorrow, the ECB is likely to do the same, almost certain to do the same thing. After all, the FOMC's minutes from its previous policy meeting at the early part of May said, participants discussed maintaining the current restrictive policy stance for longer should inflation not show signs of moving substantially toward 2%, or reducing policy restraint in the event of an unexpected weakening in labor market conditions. Now, it won't actually be unexpected, but it will be to them because they're thinking that sticky consumer prices has something to do with a tight and strong labor market when the two actually have nothing to do with one another. So, as labor market cracks continue to appear all across every angle of the labor market, including potentially layoffs in certain sectors, as we'll see in a minute, the Federal Reserve will have to focus on the economic weakness part, which means the Fed gets out of the way with its short-term interest rates, and as I mentioned, rates can go lower where they want to go because of the fundamentals of this post-supply shock economy. The post-supply shock economy where incomes never caught up to price changes, and more it looks like they're not going to. Again, the consequences are profound and widespread. Refocusing everyone's attention on the labor market today, that was ADP. ADP came out with its estimates for private payrolls in the month of May. They always come out a couple days before the main payroll event on Friday. But what ADP said was 152,000 jobs gained in the month of May. So not horrible, but that's the lowest so far this year. And more importantly, it looks like the head fake that I just told you about. Like a whole lot of economic statistics, including consumer prices, there was the acceleration or modest acceleration in the early part of this year. But then around March, maybe April, March in terms of the ADP numbers, it started to go back down all over again. So like a dead cat bounce in the economy, We had a downturn at the end of last year, a little bit of a bounce to start this year, and now rolling back over into what looks to be an uncertain summertime, to put it charitably. So ADP says 152,000, but again, more importantly, it's the trend here. We're moving lower after March, so April lower than the gains in May, even lower still. And of course, there is the usual big contribution from education and healthcare. That's just going to be a non-cyclical, non-economic part of the employment market no matter what. But they also said 55,000 jobs were gained from trade, transportation, and utilities. That one's likely to come down, especially as the goods and consumer economy stumbles even further moving forward. And 55,000 seems way out of line with what we're hearing from especially retailers and traders in those industries. So 55,000 there, 46,000 education and healthcare. There's 100,000 right from the start. And one of those, half of that 100,000 is already being threatened by the cyclical conditions in the economy. On the flip side, you've got a 9,000 reduction in resources and mining, which, I mean, that makes perfect sense. 20,000 job losses, according to ADP, in manufacturing, also making sense given what we're seeing in manufacturing data. That rolling over after that spring head fake as well, or the late winter head fake. 7,000 job losses in information. That's just continuing the media shakeup. And another critical sign, 6,000 job losses in professional business services. That's a highly cyclical indication too. But ADP also said there were 32,000 jobs gained in construction that offsets quite a lot of those declines. And that's a question we keep coming back to because the BLS number say the same thing. Essentially that there's consistent and constant growth in construction when a whole bunch of data shows that that doesn't seem likely to be the case. Or if it is the case, like in trade industries, it's not going to be the case for much longer. Also, according to ADP's data, there seems to have been the head fake, the short-run head fake this year in the wage statistics. They slowed way down to January of this year. Then they moved higher. They accelerated in February or March, which fed further into the sticky inflation fears of the Federal Reserve. Because remember, they put together the Phillips curve. Higher wage growth means it's going to become higher price growth, and we get into the wage price spiral that history shows never happens. But that's what economists believe. So that fed into Jay Powell's fears that maybe the economy wasn't slowing down enough, the labor market wasn't weak enough. That accounted for why CPIs were so sticky. It wasn't Saudi Arabian oil prices and gasoline in the seasonal pattern that they fall into. But as ADP's chief economist said, of all of the labor data that they just reported, job gains and pay growth are slowing going into the second half of the year. The labor market is solid. They always have to say that. Labor market is solid. The economy's booming. Yeah, sure, whatever. But, the labor market is solid, but we're monitoring notable pockets of weakness tied to both producers and consumers. And you love how they have to say that, right? The labor market is solid, but here's all the ways in which it doesn't look solid. The economy is booming, but 2/3 of the middle class of Americans are facing significant hardships I talked about yesterday. The economy is booming, but 8% of Americans are using buy now, pay later for their necessities. If you have to put the but on there, if you have to qualify it with something substantial, is it actually booming? And that's the question that most Americans are asking themselves. Again, it comes back to incomes, their own personal situation. But this isn't just about their perspective. They see that they fell behind after the supply shock, and they realized we're not going to catch up. But this isn't just about them not catching up. Them not being able to catch up means the economy is going to get weaker and weaker and weaker at its own pace, and do so in unusual ways like what we're seeing here, where the labor market cracks not all at once like we normally see in recession, but little by little it gets chipped away and eroded so that the foundation starts to crumble. But if you continue to say the labor market is strong, but the foundation is crumbling, you're going to be surprised when the whole thing starts to really fall down. Now, I mentioned construction because we see that again in the BLS data too, not just ADP, where it seems like there's solid and sustained construction growth. And you wonder, where is this coming from? Because you look at, for example, the Census Bureau's estimates on construction spending, and there does appear to be, yet again, Another strong cyclical signal that the overall economy, and construction is a big part of that cyclical turn, at least as an indication, it started to turn last year. Non-residential construction spending peaked around November. And so for the last 5 months, up until April, that's the latest figures, non-residential construction spending has been flat to lower. And flat to lower over a 5-month period is a solid cyclical signal. We saw this before in the prior two recessions. The data only goes back to 1992, so we can't go back to the 1991 recession. But over the previous two cycles, in 2008, the Great Not Recession, as well as the dot-com recession, we see the same thing in non-residential construction spending. It peaked in November of 2007 and then went flat to actually slightly higher for an entire year until December of 2008. And also in the previous cycle, the dot-com cycle, it peaked in November 2000. What is it about November here in construction? And then went flat to lower for about half the year, 2001, into the first part of the dot-com recession. So what that tells us is that businesses, non-residential construction, they're less willing to invest in physical productive capacities. And if they're less willing to invest in physical productive capacities, not only should that have a negative direct impact on jobs, a very small one, but more importantly, it tells us what businesses are thinking about the near-term future. If they're cutting back on their non-residential construction, their capital expenditures, in terms of building physical facilities, they're more likely than not thinking about cutting back in other ways too, including the labor market. Now, we also see weakness in residential construction too, especially all the construction data from permits and starts and moving forward, new housing sales and everything else. So they suggest that there shouldn't be a steady growth in construction jobs either. So when we start to see construction jobs in the government data or the ADP data begin to reverse, that will be a very clear sign of an even bigger crack in the labor market that ties back to businesses' perceptions of cyclical as well as future conditions. So that's one we're going to continue to watch, and really that's one we already got, which suggests more like recession than not. Key cyclical change in non-residential construction. But what if the labor market last year, which was reportedly booming, the establishment survey grew by more than 3 million jobs. What if it was substantially weaker, and not only just substantially weaker last year, was substantially weaker in the second half of last year? How would that change our picture of the economy heading into this year? How would this change Jay Powell's picture of the economy heading into this year and the risks to it? Would we be more concerned about inflation? Or would be more concerned about economic weakness? Be a lot less concerned about inflation if you believe in the Phillips curve and the employment situation was a lot weaker than you first thought. There are other employment statistics beyond just the establishment survey or the household survey. The Bureau of Labor Statistics also keeps something called the quarterly census on employment and wages. And that's an exceptionally comprehensive data set, far greater than even the establishment survey. Well, here's how they describe it. The Quarterly Census of Employment and Wages, or QCEW, that program publishes a quarterly count of employment and wages reported by employers covering more than 95% of U.S. jobs available at the county, MSA, state, and national levels by detailed industry. The QCEW produces a comprehensive tabulation of data on the number of establishments, monthly employment and quarterly wages for workers covered by state unemployment insurance laws, and federal workers covered by unemployment compensation for federal employees program. So they look at state unemployment tax payments and say, if you're paying taxes on somebody, there must be a job associated with that tax payment. So it's the most comprehensive data set on employment you can possibly get. And because of that, it obviously takes the government quite some time to put the numbers together. So they do it quarterly, and unfortunately it takes several months for them to tabulate everything and put them in, and then release the figures to the public. So the numbers for the first quarter of this year, they're not going to come out until August. So what we have just recently, toward the end of last month, were the fourth quarter stats, or really the entire all of 2023 from the QCEW. And what they showed was, well, here's from the press release. In December 2023, national employment increased to 154.8 million, a 1.5% increase over the year as measured by the QCEW. And 1.5% compares to the establishment survey, which increased by 1.95%. And that sounds like not really much of a big deal, but it is actually a huge discrepancy. Not only is it a huge discrepancy, it's when that discrepancy showed up and what that potentially means for the labor market. So when you compare all of these together, what you see is that the QCEW and the establishment survey, when you look at them in year-over-year percent changes, they actually track very closely together, which is by design in many ways. The establishment survey seeks to be a high-frequency version of the QCEW through different means, but essentially that's what they're trying to do. And they eventually benchmark themselves to the QCEW, so they're going to change as the QCEW changes. So the establishment survey and the QCEW track each other very closely, with one exception, and that was the middle of 2016 through the middle of 2017, when the labor market got pretty weak after Eurodollar number 3, and the QCEW looks more like the household survey than the establishment survey. But that was basically the only time you see that type of discrepancy between those two series until around July 2023. Beginning last July and lasting to the end of the year, the QCEW is growing at a much slower rate than the establishment survey does. And if you put some numbers to it, very rough back of the envelope calculation, this is not scientific, this is not necessarily apples to apples, this is just a rough guesstimate. It looks like the QCEW is saying there should have been 650,000, maybe 700,000 fewer jobs gained on the establishment survey than what it showed. And when the establishment survey only showed 3 million in jobs gained, which is actually a good year for the payroll report, but 3 million jobs, you take away maybe 700,000, suddenly last year doesn't look as robust, especially considering that 700,000 that we're taking away was likely the second half of the year, not the first half. And the establishment survey already slowed down significantly in the second half of the year. Jobs gained, according to payrolls, was only 1.3 million July to December. So you take away 650,000 from that, suddenly the establishment survey looks a lot like the household survey. And again, how does that change our view of risks to the economy in 2024 if the payroll report, which should look like the QCEW, actually ends up looking like the QCEW and is much weaker? Now you're starting to really, everything that's happened this year really starts to make sense, including all the warnings from all of these companies who are saying, we see trouble from consumers because there isn't enough income, and consumers are getting the hint that incomes are never going to catch up from the supply shock. So some things that we should be looking for in terms of labor market and really general economy cracks moving forward. Again, I mentioned construction jobs. That's one. If we see that cracking, then that's businesses saying, like construction spending, they're becoming more pessimistic on near-term prospects and doing something about it. We should also see more declines in cyclical sectors like manufacturing and professional business services. We've already seen that to a small degree in the establishment survey numbers. We'll see if that continues on Friday with the payroll report. Trade jobs, retail selling, and wholesale jobs, those will begin to reverse too as the consumer economy gets weaker and weaker and weaker. We also see confirmation along many lines that the late winter, this earlier part of the year, the sticky inflation economy rebound head fake that really was a head fake. So we'll see more and more data that suggests that there was just a temporary bounce in the economy. Now, heading into the spring and moving really importantly towards summer, it's rolling over all over again, as we're seeing in ADP and other statistics. So we'll get payrolls on Friday, but in the meantime, Treasury yields are tumbling. Oil and gasoline prices are falling. There's two very key market signals suggesting a reemergence of that weakness after the sticky inflation head fake stuff that we just went through. This is still a cycle, an odd one, a prolonged one, and one that's getting longer all the time, which has opened the door for these cycles within a cycle. But I think what the ADP economist said was actually a good description of where we are. She said there are pockets of weakness, and those pockets of weakness are becoming more visible, and they're continuing to grow. Markets are on edge, and it's not because of inflation risk. It's not just that oil and gasoline prices are down. We saw some weird stuff happen in the gasoline market. I talk about that in the video linked below. As always, thank you very much for joining me. Huge thank you. Eurodollar University members and subscribers. And until next time, take care.